are a bear in equities, right?
Well,
is it going to get worse for 2016?
So I think, look, the outlook for growth, first of all, that's where we always start, isn't great. Globally, that includes the US. I think at the margin there may be some upside surprise in Europe. Europe's the biggest beneficiary of the falling energy price.
Right.
The US actually isn't a beneficiary anymore as a net energy exporter. So I think the growth story remains weak. I think the inflation story remains very subdued globally. We have disinflation or deflation pretty much everywhere in the world.
Yeah.
And the US may be looking for the Fed to hike rates, but every time the dollar goes up, that's deflation hitting the US. So I don't think this Fed hiking cycle will be the shortest and shallowest on record, I think. The big concern, I think, over the next 2 or 3 months is if we see a continuation of the productivity trends, the revenue trends, and the earnings trends, not EPS, but net income, because EPS is a financial engineering game. The US corporate sector will stop hiring and start firing.
Right.
I'm not sure, as the Fed's hiking, how markets will like that or not. I think that's the risk.
But so you're not arguing that actually we will see a correction in equities because of all the cheap money being pulled away. You're basically basing this on fundamentals.
I think the fundamental story is weak, and I think the balance sheet story, the Fed central bank balance sheet story, I think is kind of in the mix. I think we've got a situation now where I think the whole market now genuinely expects Draghi to be there forever in whatever you need to do. So I think we priced Draghi out effectively.
Right.
There may be a bit more to go in terms of what he delivers. I think with Japan is at risk of disappointing markets. So I think Abe and the Bank of Japan will do more next year. That's my view. It doesn't necessarily reflect the House view. And look, I think the Fed will be on hold and perhaps even looking to cut rates this time next year. So I think all of this is in the mix. But ultimately, I do expect to see a 25% correction in equity markets from around here, maybe from a little bit higher, but marginal new high.
Yep.
And people ask me, where's the Fed put? Well, look, I'm going to simplify, but I think the Fed starts to talk about cutting rates or adding balance sheet again when S&Ps are down at 1,500.
Wow.
Bob, tell me about the twin pillars of consensus. I love that phrase. What does twin pillars of consensus mean?
In terms, well, I must have missed this story, Tom, so...
Well, you wrote it a few days ago. I mean, you're talking about the twin pillars of consensus.
I'm missing that.
Go ahead, Francine. Pick it up. Francine, pick it up.
Well, I'm not sure. I didn't write anything recently. I think the twin pillars of consensus that I think I understand is one that we're going to see a normalization in the outlook for growth. And I think the other twin pillar of consensus I think that exists out there now is that the central bank will be your friend forever.
Right, yeah, and that's one of the points. I mean, Tom, you know, when you look at some of the great minds talking about markets, it's incredible that Bob Janjuah just called for a 25% correction in stock prices. That will eventually mean the Fed may have to reverse the hike that it sees in December. So in your eyes, what, the Fed should just wait?
Look, I mean, I think the Fed is caught between a rock and a hard place. I think the point is that once we got away from the first QE, every incremental QE was creating a massive and increasingly bigger exit problem for the Fed. So you remember the story 5 years ago was Fed exit. How do we do it? What do we do? Well, guess what? We've hit the road now, right? How is the Fed going to exit? There is no easy way out here.
But so once again, 2016, the biggest risk for that year is, again, I guess, monetary action. And so we go back to the markets in a binary kind of situation.
Yes, I think you're absolutely right. I think we've got it's either all on or all off. You know, 4 weeks ago or late August, early September, the outlook for the global economy and markets was disastrous. 4 weeks later, because Draghi said something, it's wonderful again. The truth is somewhere in the middle.
Yeah.
And I think gradually what we're seeing is an increasing outlook for volatility in markets, weaker liquidity, and I think a rounding pattern in equities, which I think we're going to resolve one way or the other, and I think it's that way next year.
Dan, Bob, thank you so much. So what a great honor to have you in the studio. Bob Janjuah there with that important call, 25% correction for stock markets, I guess, in the next 12 months or so.